your financial crime compliance, risk, and controls. So the first thing that I want to do on the next slide is define what financial crime means for purposes of this webinar. So I'm going to cover today risk associated with sanctions, money laundering, bribery and corruption, and third parties. But it's probably important to note that those of you on the phone that operate in the web and mobile marketplace and in technology space, sometimes financial crime can mean other things. Oftentimes it includes fraud and cybersecurity. But I want to make it clear, I mean, obviously for time's sake, we could talk about this stuff probably all day, but considering our time, we're going to limit it to the risks that you see on the screen right now. So overall, in a nutshell, during this webinar, we're going to cover a brief overview of U.S. regulations and requirements regarding these risks, a high-level review of a compliance program and associated risk assessments with sanctions and bribery and corruption, and then we'll talk very high-level about watch list screening. So to get to know everybody on the phone, I have a poll question, and there's 3 poll questions throughout, but the first one, I did want to try to get an understanding of where everybody's at on the phone. So what is your knowledge of regulatory requirements related to sanctions or anti-bribery and corruption? So you've got some choices here. A, you have a deep knowledge of OFAC, which is Office of Foreign Assets Control, and FCPA, the Foreign Corrupt Practices Act. B, I know law, but am new to financial crime compliance, and remember in this context of these specific risks. C, I don't know, but someone at my company does. D, financial crime compliance is new to me and my company. And E, other. Threw another in there just for fun. While you're answering, I do want to just preface this, I am not an attorney. So as you're building out your compliance processes and programs, it's important to consult your chief compliance officer and general counsel. I do, however, have experience working at financial institutions and have been responsible for these types of programs, and I've been accountable to regulators and have built several financial crime compliance programs that have proven to be compliant. So. All right, so we've got about half the people on the phone that know OFAC and FCPA, so that's good, and I think this is a nice spread. I'm so curious about others, so when they show my email at the end, send me an email of what's the other. So on the next slide, I'm going to do a high-level review of the regs, and since most of the people on the phone seem to have an understanding of this stuff, it's, for time's sake, going to be very high-level. The first one is OFAC, so Office of Foreign Assets Control. This pertains to sanctions risk that we were talking about. And OFAC is an agency of the U.S. Department of Treasury. They're responsible for administering and enforcing our economic sanctions programs in the United States. The programs use things like blocking assets and trade restrictions to accomplish our foreign policy and national security goals. A couple things to note. The programs can be very nuanced and complex. So I have grossly oversimplified in the what is it. We all know that that is a very high-level description. And it's also important to note that other jurisdictions, other countries all over the world have similar regulations. So if you are, operating or offering services or products, internationally, it's important to look at the other regulations that might be applicable to you and your business around the world. So, for example, in the UK, there's the Her Majesty's Treasury list, the HMT list. So important to consider those things as well. Who does it apply to? It applies to everyone. So all U.S. citizens and permanent resident aliens and all U.S. companies, regardless of where they're located. And then the reverse is true. Anybody, regardless of where they're from, if they are on U.S. soil, cannot do business with somebody that is some entity, whether it be a business or a person, that is named on the OFAC list. Now, again, I'm going to speak in terms of OFAC, but remember there are the global regulations everywhere. So I'll speak to the U.S., but this applies internationally as well. So I like to use the example for those that maybe aren't as familiar, if my neighbor was on the OFAC list. Now that is not likely, but if they were and they had a yard sale and I went over and bought a toaster for $3, I have then violated OFAC, and I could be fined for that should I be found out. So it's important to note that no amount is too small. It could be a $3 transaction or a $3 billion transaction. There is no threshold for what is considered a violation. And it is also a law where ignorance is not an excuse or a defense to violating the law. Now, you might be wondering, well, how in the world do we not, why don't we screen or check to see if everybody we talk to is on the OFAC list? But it does kind of speak to the fact that OFAC is enforced but not regulated, except for obviously in the banking industry. We know that the banking industry has very specific guidelines and they're reviewed regularly. They are considered regulated. So the government says that you have to have programs in place to ensure that you're not, sending transactions or having accounts for people on the OFAC list. However, for most of us, U.S. citizens and other companies, it's enforced. Should you violate, you can be fined, and that is becoming more commonplace, but it is not regulated. The government does not tell us how we should determine if someone is on the OFAC list, and that is an important distinction. So we can go to the next slide, which talks about the Foreign Corrupt Practices Act. This pertains to the bribery and corruption risk, and the FCPA was designed to prohibit the payment of bribes to foreign officials in order to obtain or retain business. There are also provisions in the law that talk about the need to maintain accurate books and records and to also conduct adequate due diligence. Things to note: a bribe is considered anything of value that's intended to influence behavior. So it doesn't really say what is or isn't a bribe. It could be anything of value. It could be even services that are offered. And same as OFAC, there are similar regulations in other jurisdictions all over the world. So, for example, the UK Bribery Act is a similar regulation to FCPA. And who does it apply to? Just like OFAC, it applies to any U.S. citizen or resident and any business that operates under U.S. laws. And a little bit different, it involves any transaction that involves U.S. currency, was conducted through a U.S. bank. It could apply to even communications that were sent through U.S. email servers or that were sent through maybe a website that was hosted on a U.S. platform. So its reach is a little bit more extensive. An example is if you had two Taiwanese people where one paid a bribe to the other, if that transaction was done in U.S. currency, that would be a violation of FCPA. So a couple of things. Ignorance is not a defense or excuse for violating, so similar to OFAC in that way. And it is also enforced, but not regulated. And so when I say that, it's very much enforced. They do, frequently do enforcement actions and fine companies and individuals, but the difference is that in most cases, I say in most cases because it's not for everyone. Some are regulated, but regulated means the government requires that you have a very specific program in place to ensure that you don't violate. So moving on, we'll talk about the penalties, and this is just penalties as it relates to OFAC and FCPA. So OFAC, we know that there can be civil and criminal penalties that often exceed several $1 million. The civil penalties are actually listed on the website, but the criminal penalties are the ones depending on the egregiousness of the offense that can skyrocket. FCPA, not only are there civil penalties, but companies often have to repay any profit that they made from paying the bribe. They can also be subject to oversight by an independent consultant. And then employees can also be held personally responsible and sentenced to jail time for their knowledge or participation in paying bribes to foreign officials or foreign governments. All right, and we'll move on. So some of you might be thinking, all of this is great, but it doesn't apply to my business because I have very low risk, and that may actually be true. I think that it's in the web and mobile marketplace, and maybe if you're a startup or your customer base is fairly localized, you may actually determine that you have a low level of risk, and we'll talk about assessing risk via risk assessment later in the webinar. But there are other reasons to care about financial crime and creating a culture of compliance. beyond just the potential fines that could be associated with violations. So the first one is reputation risk. So damage to your company's reputation and brand, and then lost revenue, lost shareholder value, and obviously the cost associated with violations and doing remediations and look back projects under the heavy hand of a regulator. So just, recent things that have popped up, you certainly wouldn't want to be involved in any headlines associated with human trafficking potentially. That can be damaging to a brand. And things that maybe aren't as public, if you have violations of OFAC, those can cost you tens of millions of dollars, or even if you're smaller, just $1 million could be very damaging to shareholder value. Corporate citizenship, we know that consumers nowadays really, look for companies that are benefiting society. So creating a culture where you have an ethical and legal responsibility to benefit society. You're not participating in, human trafficking and some of the bad things that happen, narcotics trafficking around the world. And then obviously that creates brand loyalty, not just from customers, but employees and shareholders latch onto that as well. Individual accountability, even if you're not guilty, if your name is dragged into some sort of, scandal or compliance violation, that could be damaging to your reputation and your career. And then the one I think people don't think about very often is money laundering. So small businesses especially, but all companies, are often unwitting victims used in money laundering schemes. So if you don't put controls in place to not have money launderers abusing your company to launder illicit funds, they could be buying your products and selling your products and essentially sending illicit funds through your company, and you may not even know, or if you don't have employee controls in place. So we'll talk about some of the controls later on, but I think it's important to keep, can my business be used for money laundering without me knowing in mind? So one last slide in this section of the regulatory overview, and I think this points to the enforced but not regulated point. So if you look a few years back, especially for OFAC, you go back 3 or 4 years, OFAC was focusing primarily, well, actually even farther than that, OFAC was focusing primarily on the banking industry. And there were lots of fines there, and the banks have put in robust controls and programs, and they don't really have, they're doing a good job at identifying, potential matches and not doing business with people that are named on a sanctions list. And recently, most of the enforcements have been focused on corporations. So these things are coming up and starting to impact corporations. And FCPA has been, just actively increasing the number of enforcements that they are issuing. So that's becoming more common as well. I do want to call out a couple here. Elf Cosmetics, that's an interesting one. January 31st of this year, they reached an almost $1 million settlement with OFAC. They actually had 156 violations of North Korean sanctions. And that happened because two of the Chinese vendors that they were using for false eyelash kits as suppliers were sourcing the eyelashes from North Korea. And so they, at some point, realized that and voluntarily self-disclosed the violations to OFAC. It was determined to be a non-egregious case, and they reached the $1 million settlement. But it shows the importance of doing due diligence on your vendors and on your suppliers, because even if you think, okay, well, they're good, you've got to do your due diligence to see where they're getting their supplies from. On the FCPA side, Cognizant recently in February agreed to pay a $25 million settlement for violations of FCPA. And then the two names underneath that are actually two former Cognizant officials that were charged for their involvement in the bribe to a government official in India. So that covers my overview of the regulations. So now we'll move on to the details of a program, right? How to assess your risk and controls. So let's start with a poll question to kind of see where everybody's at. What is the current state of your company's financial crime compliance program. So A, we have a comprehensive risk assessment and risk-based compliance approach. B, we have some compliance controls but could do better. C, what is financial crime compliance? And D, I don't know. We will wait for that. And just to let you know, as we move through the next sections, we'll talk about the program and risk assessments, and then we will touch at a very high level on watchlist screening, which is kind of one of the first controls. I love it. Look at all of this. So you all have to reach out to me after, and we can talk about your processes. All right, so let's talk about the benefits of a compliance program, and I'm sure based on the poll results that many of you know this because you have one. So first thing, and maybe these benefits can help if you are in the bucket of, we could do better, or maybe we need to invest some more resources in this area, or we're deciding if we need to. These are some of the reasons that you can take to your, directors and board of directors and say, here's why we need to do this. But overall, the benefits of a compliance program beyond just financial crime compliance, but looking at all of the regulations that your business faces, is it can help you inform strategic decisions and budgeting, right? So doing things in a controlled way, it really is finding the balance between non-compliance and overspending. So finding that right-sized, risk-based approach. And as you are scaling, whether you're expanding into new geographies or new products, new services, whether you're targeting a new customer market, you're doing that in a controlled way, and you're evaluating those decisions in a consistent way so that all lines of business kind of have to look at the same things and ensure that they're not unnecessarily exposing the company to risk. It also helps manage the cost of risk over time. It's important to scale appropriately. Doing that risk-based approach, that acknowledgement of we understand our risk exposure, we have quantified and articulated our risk appetite and risk tolerance. That way you don't find yourself in a situation of having to go backwards and then certainly putting yourself in a position of having to overspend. Number 4 is probably my favorite and maybe one of the most important, and it speaks to the culture of compliance. Ensuring that your employee behaviors align with your company's risk appetite. So if you do things like include compliance training in your employee evaluations, in incentive structures, then you're ensuring that you're incenting the right behavior. So if you just think about it, some examples, if you've got a representative or an employee that's responsible for growing business or expanding overseas, could they inadvertently end up paying a bribe just to get a deal closed because growth is their primary objective? The same is true of choosing vendors and suppliers. Are you incented to choose a risky supplier because your profit margin goals are more important than making sure that you pick the right partner? So incenting the right behavior and articulating it to all employees. Again, it speaks to the good corporate citizenship. So increasing your company and brand, it attracts shareholders, it attracts customers, employees, partners. And then the last one may be one of the most important. There might be several company representatives on the phone that represent companies that are an integral part of a bank partnership, right? If you're a fintech, you may be involved in originating accounts for a financial institution or facilitating transactions or payments. So having a compliance program ensures that your relationships with your bank partners are stronger and easier. Even if you're just utilizing bank services, what you don't want is to get a call from your bank and find out that they're closing your account because they think that your business is too risky. So moving on. Determining risk and exposure. So before we move into the program, I want you to keep 3 things in mind. What type of company are you? So if you are a non-bank financial institution, so a money services business, a fintech, online casino, perhaps you're a peer-to-peer lender or peer-to-peer fundraising. If you're dealing with money and businesses or consumers and money, then it is very likely that you have some sort of formal requirement, some sort of formal regulation where you are regulated, and that there is guidance out there for you to follow in these different areas. If you are not regulated, there's other things to think about. Who do you do business with? Who are your buyers and sellers? Where do you sell? Who provides your services? Who are your advertisers or users of your platforms? Who are your vendors and third-party relationships? So what type of company? We're going to look at these risk assessments from the 4 different views that we talked about, the 4 different risks that we talked about at the beginning. And then the location of your company. Are you truly United States only? Are you operating in and only do business within the United States, or are you global? Because once you're global, you do have more risk in these areas. It's not necessarily bad, it's just a recognition. So let's move on and talk about the compliance program. And this extends beyond financial crime compliance. This is speaking to the overall compliance program within an organization. And I recognize that within the web and mobile technology space, there's a huge appetite for risk, and there should be, right? There's a desire for technology and reduced customer friction. And so using data and technology to make the customer experience seamless is very important. And that has to be, it's all about being measured in the risks that you take, right? Sometimes it's just recognition. So you start with your risk appetite statement. That should include the amount and type of risk that your organization is willing to take on in order to meet your strategic objectives, right? It's just articulating it for the whole organization to know. And as your organization evolves, your risk appetite statement might change. That flows down into your enterprise-wide risk assessment, and then within that specific risk assessment. And it seems like most of you on the phone have risk assessments already. That makes me happy, because sometimes when I talk to people that don't know at all what I'm talking about, this can seem very overwhelming. For those that maybe don't have this stuff in place or aren't sure, that's okay. This can be right-sized for any organization. Sometimes risk assessments can be as simple as being in a spreadsheet, or you can have, a vendor-provided tool. Sometimes it's built into a proprietary system. There really is a right-sized approach for everyone. It's more of a recognition and being measured. So talking about specific risk assessments within the enterprise-wide risk assessment, so beyond the risks that we've talked about today, the sanctions, bribery and corruption, third-party and money laundering risks, for the gig economy companies, for example, you'd also want risk assessments around perhaps labor and employment laws. For social media, you might have data privacy or data breaches as like a primary concern. Online marketplaces may have a focus on fraud. And other lending platforms like peer-to-peer lending or MSBs, money services businesses, they might be focused on credit and underwriting laws. So it's a way to capture all of the regulations that apply to you. All of those things then flow down into policies and procedures. If you don't have policies and procedures documented, you should at least at the highest level document something. It ensures that your employees are executing repeatable, scalable processes. That is always the mantra. You don't want it to be where now you've just created more work for yourself and it's kind of a waste of time. But whenever you can capture what someone is doing, you've now created a process that can be repeated and that is defensible. And that's a good position to be in. Of course, you want to do a periodic review and update. This would usually, annual seems to be a good standard, and as big things in your company happen, right? So if you're making a big change, expanding, doing something, it's a good time to re-review all of those things above. And then, of course, training and education, reinforcing that culture of compliance throughout your organization. So let's move on and talk about the financial crime compliance risk assessments. And I am going to talk about them at a very high level. Luckily, Google is our friend. I don't know what we used to do, 20 years ago before we had Google. And now you can Google risk assessments and you can get some nice templates Like I said, it's everywhere from spreadsheet, vendor provided, proprietary systems. There's all kinds of options for anything that you need. So I'm going to go through the different components of a sanctions risk assessment, and then a bribery and corruption risk assessment, and then we'll move on to the other risks. So the first thing for both is to really define what is required by law for your company. So like I said at the very beginning of this section, you may have actual specific requirements that require that you have a risk assessment. You may not. You may just have the basics, right? Just a recognition of what could apply to me. The next thing after you've done that for both is to identify and prioritize all of your risks and controls, right? So you want to go through and say, oh, we see that this could be a risk. Here's the controls in place we have. I like to, during this process, actually think like a bad guy. So put yourself in the shoes of like a bad employee that wants to do bad things. What internal controls do you have? Like, how could they exploit your system? Is there anything in place to catch them if they do? Can they move money? Can they, communicate, externally and it's not being watched? Like, what are your internal controls? How could a customer, a bad customer, if you had a whole bunch of drug money or money you've earned from fraud, like how could your system, how could your platform, your offering be exploited for bad guys? And then once you've done all of that, you can see where your biggest risks are, and then you can move down into the other sections. So I'll focus on sanctions for a second. It's usually broken up into 3 parts. The first is geography. So your sanctions risk is going to vary depending on how many countries you operate in. If you are global, even if you're only located in the US, if you're doing business globally, you're going to have more sanctions risk than if you're only operating in a localized area in the US. So looking at it from that angle. Then products and services, obviously selling diamonds on the internet might be considered more risky than selling cupcakes on the internet. So consider the products and services that you're offering and the risk associated with those. And then you want to consider any entity that you're doing business with. So whether it be your customers, suppliers, vendors, partners, looking at the different groups that you might have to consider. And those are the 3 components of the risk assessment. If we move over to the bribery and corruption side, geography means a slightly different thing. You want to look at the areas that you're operating in, but you want to look at how prone that country is to bribery. In some countries, it is far more commonplace to have bribery happen. So you want to evaluate it through that lens. You also want to consider the industry sector that your product or service is offered in. So construction and pharmaceutical industries, for example, are more prone to bribery. Type of relationship, look, a customer example would be, is it a new customer or a known customer, right? A known customer may present less risk. You've already done due diligence. Same thing with nature of relationship. If I have an exclusive joint venture partner that I know very well, that may be less risky than perhaps an independent sales consultant that I have based in China that I only meet once a year, and I don't really have a lot of visibility into what that individual is doing. And then for both, there's the periodic review where you would want to update this annually based on what you offer, or at any point where you are making a big strategic change or decision. So we can go on to the next slide. So these things aren't really as much in the form of a risk. These 2 types of risk aren't in the form of a risk assessment necessarily. There are other things to consider. So your third-party risk, you really want to view that as like a vendor management program. So everybody that you have a relationship with, you want to make sure you're thinking about it, conducting due diligence, make sure you have contracts in place and that you're holding your vendors and third parties, people doing business on your behalf, your agents, hold them accountable and have terms in there, have a vendor management program, if you will. Obviously, it's going to vary. If you are buying a bench for your lobby, for example, that is not necessarily a risky transaction. You don't need to put them through this rigor. But if you're, deciding what telecommunications company to use to provide to your entire organization, that might be a more critical important relationship that requires thorough due diligence. And then, of course, money laundering risks, you could put this in the form of a risk assessment, but really looking for what controls do I have for employee oversight. Not being a bad boss or overly paranoid, but are there controls in place to make sure that my employees aren't moving money or committing bad acts? Billing and payment practices, and unusual activity detection. How often do you know what is normal? Do you know what a normal buyer, whether it be services or goods, what does that look like for your company? And can you define it? And can you detect it if it appears to be unusual? And so all of those things that we've just talked about trickle down into your policies. And I don't have time to go into all of the details of a policy, but at a very high level, your OFAC and sanctions policy really speaks to the who, when, why, and what of a program. So who should you be screening? Who should you be looking at? When and how often should you be looking at them? Why? You want to articulate why, against what list. You want to articulate reporting requirements and any controls and third-party tools you have in place. Your policy will speak to your audit program and any training programs that you have. It really is the why you decided to do what you're doing, and then articulates what it is you're going to do. And the same is true for like an anti-bribery and corruption policy. You really define the types of due diligence that you do in different situations, whether it be onboarding a third party or during a merger and acquisition. How are bribes handled? You know, like what is your company's view and policy on commercial bribery, bribery of government officials, facilitating payments, all of your cash and high-risk transactions, gifts and entertainment policies. So lots of things. Also audits and controls and use of third-party tools go into that as well. We could have a whole nother webinar on policies and procedures. Perhaps we will someday. So the next thing I'm going to go into is watch list screening. So let's go back one slide to the poll question, because I want to get an idea of everyone on the phone's watch list either screening program or knowledge of watch list screening at all. So the watch list screening program at my company is A, outsourced or partly outsourced. B is handled by a large or relatively large department. I'm thinking that means 4 or more people. C is handled by a few people, so 3 or less people. D doesn't exist, or E, I don't know. We will wait for that to come in, if you're all still awake. All right, what have we got here? So a few people, so that seems about right. And that actually kind of speaks to the other poll questions, right? You've got things in place, controls in place, and then it seems like the right amount of having the internal review. Just to talk about watch list screening at a high level, first, what is it? So we've talked about, and it seems like most of you on the phone know, I do want to cover it for those that may not, because I know I'm jumping into a very specific piece of the overall financial crime compliance program. So one of the primary initial controls that you can have in place to look for is this a sanctioned entity? Is this a potential government official or, for government entity, state-owned enterprise? Does this person present additional risk and adverse media? A way to identify that right up front is to screen against watch lists. So beyond just OFAC lists, there are other lists that you can screen your relationships against in order to help you quickly identify that there may or may not be a risk here, and that's called watch list screening. So you can be certain that your banks and the shipping companies that you do business with are doing this, and so you certainly would not want to be in a position of sending them especially depending on your business. And if you're in the fintech space, you don't want to be sending them transactions that then give them an alert where they've found it for you, because that only highlights a gap in your process. So it all starts, like I've got on the screen here, the watchlist screening program overall. It all starts with clean data. You really do have to have at least a name, a clean name. If you're accepting things like Mickey Mouse into your system, if you're not doing any kind of, end user customer verification, that can create challenges. Now, maybe you don't need to. Maybe you're at the point in your company, or maybe your company doesn't offer goods or services where that would matter, and you don't need to have the customer name. But certainly for vendors and suppliers and partners, you will have more information and accurate information. But you want the most information that you can going into the system, right? So you want an accurate name. It's nice to have an address. If you have other identifiers, date of birth, ID, those are important, because then the better the data is going in, the more accurate data you're going to get coming out. When we talk about alert generation, right? Well, I guess I'm going to back up one. Also on screening input, you want to determine what you're screening against, right? If you only operate in the US, maybe you only screen against the OFAC list. If you're operating globally, you want to include watch lists from other jurisdictions. You need to screen against those as well. So lots to think about on both sides for screening input. The result of screening is you generate alerts, and that is a potential match to the watch list. So if I put in John Smith, and there's a John Smith on the watch list, I'm going to get an alert that says, okay, that you may have match here. This is a John Smith on the watch list. I will say that this space in the compliance industry, in the compliance world, is evolving. So for web and mobile marketplace companies, this is an exciting time, because banks have spent decades scaling their operations with people, and it's been really inefficient, right? They review thousands and thousands of false positives, like potential matches that turn out not to be matches. And because you're in a position of not being regulated, not being told how to solve the problem, you can actually adopt new technologies like machine learning to say, we can do this better. We can do this matching, this alert resolution, a remediation with technology. And you can adopt that in a controlled, risk-based way to make your process even cleaner and more efficient and more scalable. So being a technology company is definitely an advantage here when you're looking at implementing a watchlist screening program. For those of you that have watchlist screening programs, look into it. Look into what's available, what's evolving right now in the marketplace, because you could potentially reduce the number of manual alerts that you're having to review in your program. So now is a good time. The next step, obviously, you're still going to have some alerts, even if you're using technology to be as efficient as possible in generating alerts, you're still going to have alerts to review. So that's where you consider staffing. I don't know, I get the sense that not every company gives much thought to potential spikes in alerts and the up and down and cyclical nature sometimes of these things and the demands. So figuring out how to best utilize and maximize your staffing in this area. And then, of course, if you're not using a software system for this, maybe you've done something like a proprietary system or you're doing it manually, you want to be able to record and report on your searches. So having some sort of retention policy, record keeping, reporting policy, how you can prove what you searched and when. And one other thing, OFAC relations, and actually any kind of regulator point of contact. I don't think that's often defined in a policy, but it should be, because you certainly don't want just anybody at your company reaching out to OFAC and saying, hey, I think I have a potential match here. Those should be funneled, through the chief compliance officer or general counsel. But articulating that in a policy, articulating that in a procedure is important because otherwise people don't know, right? If you don't define it, how are people going to know? And I will say just one other thing before we move on, just like risk assessments, there is every level of, complexity for watchlist screening. You could be at a manual phase where maybe you're going out to the OFAC website and typing in a name. It could be completely manual, ad hoc. You could be using a vendor, or you might even have like a CRM tool that you're using that may have this functionality that you could have enabled through the tools that you're already using today. So it can be right-sized for any point in your process. So I know there are multiple CRM tools that have like a cloud-based app store where you can do watchlist screening enabled inside of your CRM tool. So if you don't have that, look into that. And then the last thing that I'll cover are different ways and things to consider when executing your financial crime compliance program. So I do believe that some things should be internal at any size. So regardless of how big or small you are, especially this speaks more to the small, but dedicating at least one person, whether it be the general counsel or a chief compliance officer, dedicating them to compliance and evaluating your business through this lens is critical. As you grow and as you scale, does it make sense to expand internally or potentially outsource some things, but always at least have one. Technology versus manual. It's important to kind of watch your process. I know that all of the web and mobile technology companies already have efficiency in mind. So I'm sure that there's not a whole bunch of manual inefficiencies going on, but there is always a point where risk assessments can go from incredibly manual and from the spreadsheet to a better system or a different system that's more automated and, organized. Watchlist screening, you could know when to move to a more complex tool. Same thing with due diligence and third-party risk management. There's lots of tools out there, but just evaluating when it makes sense from a cost perspective and a risk perspective. Outsource labor-intensive processes. Not many companies have an interest in growing large teams of analysts. Using vendors and outsourcing those types of processes so that you can focus on your core competencies of your business and not being worried about having teams and teams of analysts that are reviewing OFAC alerts and doing due diligence reviews and all of those things. And then also get help when and where needed. So leverage the expertise of your financial crime compliance vendors. I know in the case of LexisNexis Risk Solutions, we do this all day, every day. We love it. We work with tons of companies, every company, so that you can focus on what you're good at and leverage our knowledge and expertise to help you execute your processes. And then hiring consultants. Consultants can help you develop your compliance program all the way through executing your compliance program. So leverage your vendors and consulting services for things like that when needed. But I think that about wraps it up. There are a whole bunch of things we didn't cover that fall into a financial crime compliance umbrella. Things like know your customer, due diligence, building scalable, efficient, and effective compliance controls is really the focus. So I know my email will be